Very good morning, everyone. So in the last lecture, we have discussed some very interesting questions regarding total income. So let us continue with that series. So we are doing questions from our study material. This is page number 9.34 of your income textbook of ICI study material. So let's start with question number 8 today. Again, question number 8 seems to be a total income question, right? Before reading this question, I have also mentioned this in the last lecture. Before reading the total income question, you should know what are the requirements of the examiner, actually what they need from us. So let's come at the end of this question. It says compute the total income of Mr. I. Why? So do we need to compute the tax liability also? No, they are asking about just the total income. Fine enough. For assessment here, this under the optional tax regime as per normal provisions. So we don't have to apply default tax regime over here because they are asking only regarding optional tax regime. Whereas in the previous questions which we did yesterday, we have done it by both the ways, by default tax regime also, by normal regime also, by optional regime also, because they were asking in that fashion. But here it is only regarding optional tax regime. Okay. So now start with the question. It says, Mr. Y carries on his own business. Okay, so he must be having his business income. An analysis of his trading and profit and loss account for the year ending this revealed the following information. See, sometimes they can give you an entire P&L account, but sometimes they can give you information regarding the P&L account. That is fine with us. So the first point says net profit as per P&L account is 11,20,000 rupees. So this should be the starting point whenever you will be computing your PGBP, whatever is your profit, or it might be loss. That should be your starting point. So we'll start with this while computing our PGBP income. Second point, it says the following income were credited in the profit and loss account. So there were income which is credited to the profit and loss account. We understand that if in case in their P&L account, if the assessee has credited certain incomes, let's say if they belongs to section 28 or section 41, if they belong to section 28 or section 41, 28 is charging section of PGBP. It contains most of the income which is covered under PGBP. 41 is deemed PGBP income, correct? So if they belong to this particular sections, if they are related to your business and profession, then we are fine with it. If assessee has credited that income in their P&L account, we are okay with it because these are PGBP income. But in case the problem arises when assessee credits any income in their P&L account which is related to some other head, or if they are exempt, then what we have to do is, if there is some other head income or exempt income, then we have to take it out from here while computing your PGBP. So you can say while computing your PGBP, you have to subtract those income because they are related to some other head, right? Or they might be exempt also. So you have to take it out. If they belong to some other head, then you have to take them to their respective head. So first of all, whatever is credited, take it out from here and please bring them in their respective heads. Take them to their respective heads, correct? So second point says the following income were credited in the P&L account. So let's see what are these types of income. Income from UTI is 22,000. So we understand this is IFOS income. We have to take it out from PGBP. We will take it to IFOS. Interest on debentures, IFOS. Winning from horse races, again IFOS. So all these three income is related to IFOS. So we have to subtract while computing PGBP and we will take them to IFOS. If you look at this, here it is written gross amount. So it's okay with us if they have written it gross amount because this is before TDS, correct? If they would have mentioned, let's say in your examination, let's say examiner gives you that income from UTI is 22,000, but they will write it net amount after TDS. So what you have to do is, see, in your P&L account, if 22,000 is credited and this is a net amount, first of all, take it out from PGBP. Take it out from PGBP, whatever it is, whether it is net, whether it is gross, take it out from PGBP. But when you will take it to your IFOS head or any other head, you have to take that income at a gross level. Right now it is gross. So we don't have to do any type of mathematics over here. But if this would have been net amount, here in IFOS, while taking into IFOS, please always take it at your gross level. So how you will do it? You will do a plain mathematics. Let's say income from UTI, 10% TDS has been deducted. So it means that this is the 90% amount. So you can make it at gross level. How? You can simply do a calculation, 22,000 divided by 90% or 9200, whatever you know this. So please take it to your other head every time at a gross level. So here we don't have to do any mathematics because it is already at a gross level. But yes, they are IFOS. Third point. Are you all getting this? Okay, third point says, it was found that some stocks were omitted to be included in both opening and closing stock. See, what they have done is they have omitted some opening and some closing stock from their P&L account. So you have to rectify this mistake. So how much is the opening stock which is omitted? 8,000, closing stock 12,000. So what you will do, you don't have to learn anything. Sometimes students learn that we have to subtract, we have to add. No, please don't learn anything. Just apply your logics. Some problem is happening. Okay, let it be. This is P&L account. So if you will rectify this mistake, opening stock is 8,000 rupees. So if you rectify, you will put 8,000 towards opening stock. So where you are keeping this figure, where you are keeping this amount on the debit side, that is the expenses side. Your expenses are getting increased. So please tell me what effect it will make to your profits. If your expenses are getting increased, your profit will be decreased. So that means you have to subtract, right? You have to subtract because your expenses are getting increased. Similarly, closing stock is omitted to the extent of 12,000 rupees. So if you rectify this mistake, you will put 12,000 rupees towards the closing stock. So closing stock comes on the credit side. So you will keep 12,000 rupees to rectify this mistake. Now you are increasing your credit side. That means your income is getting increased. If your income is getting increased, your profit will be increased. So you have to add this. So here you will subtract, here you will add. Got it? Fourth point says 1 lakh rupees was debited in the P&L account being contribution to a university approved and notified under section 35(1)(2). Okay, 35 is more than enough. So we understand that this is contribution towards scientific research. And is this an in-house research or it's an outside research? It's an outside research because we have contributed, we have given some donations for approved scientific research purpose. So it's a donation. Tell me, assessee has debited this amount. So should we allow it or not? You understand? Here we are following optional tax regime, correct? Because we have seen that examiner is asking just to compute the total income by using optional tax regime. So we understand in optional tax regime, see in section 35, we have two kinds of research. One is in-house and second is outside research. Outside research is nothing but a contribution to approved universities or institutions, etc. In-house research is what you do for your business. So in-house, in optional tax regime, both the type of research is allowed. Both type of research is allowed, whether it is in-house or it is outside. But if you follow default tax regime, then in default tax regime, we know that only in-house is allowed, outside research is not allowed, right? So this is outside research. But here in this question, we are just following optional tax regime. So it is okay with us. So we can allow this particular point 1 lakh rupees. So 1 lakh rupees is allowed. So we don't have to do any type of mathematics. We don't have to do any type of addition or subtraction. We will simply give it a note. We have to, I can say that we have to ignore this point, but we cannot ignore it completely. We have to tell to the examiner, yes, why we are ignoring this point. So simply 1 or 2 lines we can give as a note that this is allowed while following the optional tax regime. That is the reason assessee has already debited. So we are okay with it. Correct. I'll tell you how you have to write it. Okay. Point number 5, it says, salary includes rupees 20,000 paid to his brother. Can you pay the salary to your family members? The answer is yes, you can pay. But if they are unreasonable, if they are more than the fair market value, then excess amount is disallowed. If you remember the section, you can quote it. Otherwise, it's okay. Even if you don't quote the section number, right? You can simply say that this amount is paid to the related person. Here it is brother. And if it is more than the fair market value or it is unreasonable. So if you remember the section number, you can write it down. It is section 48(2). Correct. So it says that which is unreasonable to the extent of 2,500. So 2,500 we have to disallow it because there is a section 48(2). If you can quote the number, go and quote it. Otherwise, you can simply write the provision. Even if you write the provision, you will get the full marks. Don't worry about it. 6th point. It says Advertisement expenses include 15 gift packets of dry fruits costing rupees 1000 per packet presented to important customer. So what the assessee is doing over here, they are doing a sales promotion. So there is some advertisement expenses and there might be some advertisement expenses in my profit and loss account, which includes 15 into 1000, which includes 15,000 rupees. And why we have debated this amount? Because this is a kind of sales promotion. Can you give gift to your customers or clients? The answer is yes. It's a simple business expense. You can easily allow it. Is it a personal expense? The answer is no. You have not given the gift to your relatives. You have not given the gifts to your family members. You are giving gifts for your business promotion. That is completely fine with us. So this point is also not that relevant for our computation. But yes, we can simply give a note here. We can simply give a note here and here also, because we don't have to consider them in computation. We have to simply give a note that why we are ignoring these points. 7 point says total expenses on car was 78,000. Okay. The car was used for both the business and personal purpose. So we understand if there is any common expense, then we have to allow only proportionate expense that is only related to your business and profession. So it says that 3/4 is for business purpose. So we understand if 3/4 is for business, 1/4 is for personal purpose. So 78,000 into 1/4, you have to disallow it. You have to add it back. Correct? Easy. 8th point. Now you must be getting some confidence because we have already done few questions. Now you must be getting some confidence. And I tell you that practice will make you perfect. This is an old saying, practice makes a man perfect, right? A woman also. Okay. 8. Miscellaneous expenses include 30,000 paid to AN company. So there might be some miscellaneous expenses that includes a payment made to AN company. Regarding what? This is 30,000 rupees. A goods transport operator in cash on 31st January 24. So during the year, we have made a cash payment of more than 10,000 rupees. This is to a goods transporter. So we understand the general law says that if you are making a payment of more than 10,000 rupees in a single day to a single party, then we are not going to allow it. So we have a section. If you remember the section number, you can quote it. It is 48.3. And this is quite an important section. 48.3 says that if you are making a payment of more than 10,000 rupees, we are not going to allow it. But yes, there are certain exceptions to it. And one of the exception is if you are making a payment to the goods transporter, the maximum amount, the limit is 35,000 in that case. So the limit is 35,000 in that case. And we are making this payment within that limit, which is allowed. So 35,000 up to 35,000 is allowed. So we are making 30. So there is no issue at all. Again, we have to ignore this in computation, but yes, we will mention it as a note. Depreciation debited in the books was 55,000. Okay. Depreciation allowed as per income tax rules is 50. So they have debited 55,000 and you have to allow only 50. So either what you can do is you can disallow this 55,000 because this is as per books of accounts. You have to allow as per income tax act. So you can add back this and you can subtract this. This is easy. Or you can do the difference also. That is easy. So this you can do. 10th point says drawings of 10,000 debited in the book. See, if the assessee has made a drawing, it's a personal expense, right? If he's taking out some money from the business and he has debited as an expense, no, it is not allowed. So you have to add back. It's a personal thing. 11th point says investment in NSC. NSC is National Savings Certificate. We know the deduction is available under 80C. And whether we can give the deduction under 80C over here, the answer is yes, because we are following optional tax regime. So we can give 80C. Let's read it. Investment in NSC is 15,000 rupees debited in the books. See, he has debited this investment. Actually, it's an investment. And assessee thought that this is an expense. So they have debited this. So first of all, while computing your PGBP, you have to add back because this is not an expense. Second thing, because now the assessee is following optional tax regime, so we can give 80C deduction. So 80C deduction would be there. So now you have to compute your total income. Here I would like to request you to pause the video and please attempt this question. Then you can cross check with my solution, right? So let's start with this answer. So I believe that you have already completed this question. Let's check it. Okay. So this is answer number 8. Always mention the answer number properly and start the new question with a fresh page. Computation of total income of the assessee, assessee's names, assessment year, and the scheme which you are following, optional text regime. Here we know that we have only two heads of income. One is PGBP and the other one is IFOS, correct? And we don't have to calculate any tax and so there is no point in making a separate PGBP note. You can do the calculation right over here. If this would have been a question which contains more than 3-4 heads, or if you have to calculate the text also, then you can make the separate note for PGBP. But here it is actually not that much required. That is the reason I have solved it right here. PGBP. So this was a net profit. We have subtracted the IFOS income, which was credited, opening and closing strong adjustment that we have already discussed, depreciation, drawings and all. So then we have IFOS income, gross total income. We have give the deductions, given the deduction also under section 80C, and this is our total income. I believe that you have done this. And also please mention the notes, because there were certain points which were mentioned by the examiner, but we have not taken that into our computation. We have to ignore them. So we have to tell the examiner that why we are ignoring your notes. So here I have mentioned that contribution to approved scientific research institution is allowed. That is not problem. That is no problem under optional text regime. Advertisement gifts to customer is allowed as a sales promotion expenses, and cash payment to goods transport operator is allowed up to the amount up to the amount of rupees 35,000, and here we have made within that limit, so we are okay with it, right? So this is your answer number 8. I'll also share this PDF with you so that you can cross check. Now come to next question, question number 9. Okay, it is not a total income question, but still let's discuss this. Bala Murugan furnishes the following information for the year ended 31st March 2024. Okay, income from textile business, loss, income from house property. I believe it's a set of question, correct? So what we have to do is we have to compute his total income. Okay, we'll compute the total income. Second is tax liability and also advanced tax obligations under the default tax regime under 115 BAC. Okay. So here some income or losses are mentioned of the assessee which they have earned or incurred during this year. And the examiner wants us to compute their total income, their tax liability, and also advanced tax obligation. What is advanced tax obligation? You understand that if in case the assessee's tax payable is 10,000 or more, then advanced tax obligation arises. So here we have to tell the examiner whether the advanced tax obligation would arise in this case or not. Correct. So let's first calculate the total income, then the tax liability, and then we will comment on the advanced tax obligation. It's a good question. Such type of questions you can see in your examinations. Set off is something, it's a very easy chapter, very small chapter, clubbing and set off, but they are very important from examination point of view. Pick any paper of any attempt, you will find the questions of set off and clubbing there. So these are, sometimes students say that sir, these are very easy, let's skip those chapters. No, please don't skip them, these chapters. These chapters carries marks. Always examiner gives you questions from these chapters also, clubbing and set off. Okay, let's start. So assessee has income from textile business. This is PGBP income. In fact, it is a loss 1,35,000. So it's a PGBP loss. I can write it down over here. It's a PGBP loss. Now please tell me, what do you know about PGBP loss? Can it be set off from other PGBP income? The answer is yes. It can be set off from other PGBP income also and from other heads also, except salary. Of course, from casual income we cannot set anything, set off anything. But yes, from salary also you cannot set off PGBP loss. And also whether this PGBP, it's a is it a speculative business? The answer is no. Textile business is a non-speculative. It's a normal business. Can a normal business loss can be set off from your speculative business loss? Answer is yes. Normal can be set off from speculative, whereas speculative cannot be set off from normal. Vice versa is cannot be there, right? So you can set off PGBP loss. This is normal loss. See, here it is speculation business income also 1 lakh rupees. So can this loss can be set off from this income? The answer is yes, sir. Normal loss can be set off from speculative, but if this would have been speculative loss, this would have been normal income, then vice versa is not possible. Income from textile business loss. Income from house property 15,000 is a loss. Tell me, house property loss can be set off from any head. Of course, apart from casual income, because from casual income we cannot set off anything. But can a house property loss can be set off from any head? The answer is yes, if you are following optional tax regime. If you are following optional tax regime, house property loss can be set off from other heads to the extent of 2 lakh rupees. This we all know. But sometimes students forget that if you are following default tax regime, please remember this is important. If you are following default tax regime, and in this question we are following default tax regime, house property loss cannot be set off from any head. It cannot be set off from other heads, right? So here, house property loss of 15,000. Sir, it is less than 2 lakh, whatever. If you are following default tax regime, you cannot set off house property loss from other heads. It has to be carried forward, right? In default tax regime, you cannot set off. If this would have been optional tax regime, then we can easily set it off from other heads of income, except casual, of course. Lottery winning 5 lakh rupees, so it's a casual income. No loss can be set off from this winning. We have to pay tax at a rate of 30%, and it's a gross amount. Speculation business, we have profits. Income by way of salary 270, and it is computed. What does this word computed means? That it is the final amount of salary income. Standard deduction and everything has already been taken care of. It has been given already. So this is the final amount 270. Long-term capital gain of 70,000 rupees. It's again a positive amount. And you understand, is it 112A or just 112? 112, because in 112A we have a tax rate of 10%, but here we have 20% tax rate, and in 112A we have to apply 10% rate in excess of rupees 1 lakh. I believe that you remember that concept, correct? Okay, so we have a loss in PGBP and we have a loss in house property. House property loss cannot be set off from other head, so we have to carry it forward. PGBP loss can be set off first from PGBP income. Is it speculative? Can we set it off from speculative? The answer is yes. But if it would have been the reverse case, speculative loss cannot be set off from normal business. It can be set off only from speculative profits. But here, normal, non-speculative can be set off from here. So, but the problem is, this is 1,35,000 and this is 1 lakh. Okay, up to 1 lakh you can set it off, but still there would be 35,000 loss. So can this 35,000 can be set off from casual income? No. Can it be set off from salary? No. PGBP cannot be set off from salary. Can we set it off from capital gain? Yes, we can set it. If this would have been reverse case, capital in case there is a loss under the head capital gains, then it cannot be set off from other heads, right? In fact, if I tell you, if there was a short-term capital loss can be set off only from short-term capital gain or long-term capital gain, but not from any other heads, right? But if it is long-term capital loss, it can be set off only from long-term capital gain, nothing else, not even short-term capital gains. So long-term capital gain cannot be set off from any other head. In fact, not from short-term also, it is only allowed from long-term capital gains, right? But if there is any other head loss, can it be set off from capital gain? Yes, capital gain can help anyone. Capital gain can help anyone, but they will not take help from others. I can say it this way. So this 35,000 loss. So 1 lakh will be set off from here. 35,000 can be set off from here, right? So this loss will be set off this year itself, but 15,000 rupees loss, that we have to carry it forward. So let's start with this question also. And I would again request you to pause the video, do this question. These types of questions are very important for examination. You can see past year papers, you will find such type of questions there, right? So let's start with this. Okay, so have you completed this question? So this is answer number 9, and we have to compute the total income and tax liability, and then we have to comment regarding the advanced tax obligations. And here we are following default tax regime. So there was income under the head salary. See, we have salary income, and there was loss of house property, but we are following default tax regime. House property loss will be carried forward. It cannot be set off from salary. There is a loss from PGBP, but we cannot set it off from salary. So I have written it over here, salary income as it is 2.7 lakh. House property loss to be carried forward. So I have written it dash over here, and 15,000 rupees loss shall be carried forward. It cannot be set off from other debts. PGBP, we have speculative business income 1 lakh. We have textile business loss, non-speculative loss of 135, but we can set it off only to the extent of 1 lakh. So entire income is now set it off from this loss, and there is PGBP income as 0. Capital gain, there was 70,000, and we have a PGBP loss, that the remaining PGBP loss is 35,000. We can set it off from capital gain. We have already discussed it. So now the capital gains comes to 35,000, and casual income is 5 lakh. So we have gross total income 270 plus 35 plus 5 lakh, it is 8 lakh 5,000 rupees. Deductions under chapter 6, it's not there. Total income is, in fact, when you follow default tax regime, there are very minimum deductions under chapter 6. For intermediate level, we have 80 CCD2, employer contribution to new pension scheme. We have 80 CCH2, employer contribution to Agniveer scheme, and we have 80 JJAA new workmen, right? Additional employee cost. So we have now total income of 8 lakh 5,000. We are following default tax regime, so we should apply slab rates of 0 to 3 lakh, right? So should I apply slab rates of 0 to 3 lakh, 3 to 6 on this entire income? The answer is no. Why not? Because we have some special income also. So whenever you have to compute the tax on your total income, you have to first find it out whether we have any special income which is chargeable under special rates. The answer is yes. We have a long-term capital gain. We have a long-term capital gain of 35,000. We have casual income, which is taxable at a rate of 30% of rupees 5 lakh. And then we have remaining income. We have remaining income of 2,70,000. So LTCG is taxable at 20%, right? This is not 112, this is just 112, 20%. Casual income, we know 30%, and then remaining income, we can apply slab rates, right? And the slab rate here is 0 to 3 lakh. So 3 lakh is the basic exemption limit. Now you understand, if we have unexhausted, this is important. If we have unexhausted basic exemption limit, see, our basic exemption limit is 3 lakh, but here we have only just 2.7 lakh, and we have income under other rates. So can we, whenever we have a basic exemption limit, can it be taken from other income? The answer is yes. We can take the help of other income, but not casual. We cannot take the help of casual, but yes, we can take the help of LTCG to make it up to the basic exemption limit. So how much is the remaining amount which is left? 30,000 rupees. So here it is already 2.7 lakh. We are short with 30,000 rupees. So what we will do, we will take 30,000 rupees from here, and we will move it towards remaining income, so that this amount comes to 3 lakh rupees up to the basic exemption limit. So this we all know that this is the unexhausted basic exemption limit concept. So if the assessee is a resident assessee, then we can do this, correct? So here, if we'll move 30,000 from here, so we are left with 5,000 only. In LTCG, we are left with 5,000 only, right? So now on this 3 lakh, there would be the tax 0, right? 0 to 3 lakh is 0. On this 5 lakh, it is 30%. And on this 5,000, not 35, now it is 5,000 just. On 5,000, we can apply 20%, that is 1,000 rupees. So this is how I have calculated the tax over here. On casual income, it would be 5 lakh into 30%, 150. On LTCG, it is 20%, 1,000. And on remaining income, 3 lakh, it would be nil. So my tax comes to 151 plus cess 157,040. And because there was a casual income of rupees 5 lakh, so we understand there is a TDS implication also on casual income, that is 30%. So how much was the lottery income? It was 5 lakh rupees. 30% of that is 1,50,000, which has already would have been deducted by the lottery organizer. So we are left with 157 minus 150, 7,040 rupees. So this is the tax payable of the SEC, 7,040 rupees. So the examiner is asking us to calculate the total income. We have calculated at as 8,05,000. They're asking about the tax liability. We have also calculated the tax liability. Now they are asking us, the third thing is advance tax obligation. So you understand the advance tax obligation would not be there as the tax payable is not more than 10,000 rupees. If it would have been exactly 10,000 rupees, then advance tax obligations could have been there. But here now it is less than 10,000, so advance tax obligation will not arise. You can write it down. Also, I have mentioned it over here how I have calculated this tax. I have also mentioned it over here. First of all, house property loss cannot be set off from other heads when you follow default tax regime, so it will be carried forward. And how we have calculated the tax, I have also mentioned it over here. Correct. So this was question number 9, and should we keep it till here? Okay, I'm keeping it this video right till here. Then we will continue in the next lecture. Till then, thank you so much. Bye and take care.